And I have carte blanche with me once again. Today, we are going to be discussing private credit amidst, well, this seemingly large market downturn.
Yeah, I mean, it's been a month, right? This is market correction at this point.
Absolutely.
Yeah. Um, I mean, we're looking at this, we're, trying to guess what it could be long term. And I think one thing that we're using as a barometer is private credit. So let's just take some time today. Let's unpack what that actually is, why it matters, and how we're using it as a gauge for what might be coming down the line for the rest of the market.
It's funny because private credit, it just sounds like one of those phrases that's right out of Wall Street. But if you care about your portfolio or just about the health of the economy, then it's worth understanding what private credit's role is in our modern economy. So think of today as we're walking us or as we're walking this through step by step, in just very basic English. We're using private credit as a way to stress test the entire financial system. So we're going to try to keep it practical. I'm not trying to turn you into a credit analyst, but but Blanche and I are going to give you a way to look at a few tickers and say, okay, this is telling me something about how fragile or stable the whole market system is right now.
Yeah. Okay, so let's the basics of private credit, right? So let's say you own a business and you need money. Traditionally, you have three options. You go to a bank, get a loan, easiest one, right? A little bit more complicated. You get yourself a ticker. You go to public markets. You issue a bond. You sell some stock. But if those avenues aren't open to you, if you're a private business that just isn't big enough for Nasdaq or whatever, private credit is your third option.
Yeah, so private credit, essentially, instead of borrowing from a bank, you borrow from a big investing fund, and their entire job is writing loans. These funds are run by what we call alternative asset managers. You can think of names like Blackstone, Ares, Apollo, KKR, or Blue Owl. They're not banks. They raise money from investors, and then they turn around and they lend all of that money directly to companies.
And I think really what you need to think about there is that keyword private. These don't trade on exchange like stock or a treasury. I mean, the main company does, but the loans themselves don't. So you can't just pull up a price chart on your phone and see how the borrower's doing. These terms are negotiated behind closed doors. So when you hear private credit, you need to think about big funds making bespoke loans to companies, and these are coming at higher interest rates. So why? How is this happening? Um, well, we all remember 2008. You've all watched The Big Short. You've all watched Margin Call. Um, After the financial crisis, regulators said to these banks, you can't take on as much risk as you used to. You have to hold more capital and you have to tighten up on the riskier stuff. So the banks pulled out of the leverage lending, but people still needed that, right? The demand for loans didn't disappear. So, you know, oh yeah, well, I should also point out that this time interest rates were at their lowest, right? And investors were desperate for yield. They were asking, where can I get more than 2 to 4% on my money?
And that's really where, private credit funds step in and say, "Hey, you know what? We're going to handle the loans that banks don't want on the balance sheet. Maybe they're really opaque, maybe they're hard to value. Maybe they are just a little bit on the riskier size or on the riskier side. So we'll lend to mid-size and larger companies. We'll just do it privately, away from the public eye, and we'll pay any kind of investors, anywhere from like 7 to 10% if they accept the risk, right? The risk of
Yeah, yeah,
investing into these
exactly.
smaller private companies. So over the last 15 years, this market explodes in size. It goes from being a niche fund type into a literal multi-trillion-dollar asset class.
Exactly, exactly. That it's 20 times growth since 2008. And who they are loaning out to, these aren't just random industrial companies. A lot of the borrowers are software and tech adjacent businesses. So let's imagine like a private equity owned company. They have a software. that goes to I know doctors, so we'll say doctors or school districts, fuck it, or even restaurants. Okay, so this software is growing fast. It doesn't generate a ton of free cash yet, but the private equity that owns the company wants to leverage and juice the returns. So a bank might say, it's a little spicy, we're not going to do it. Private credit fund will says, we'll do it, but at a higher rate and with some covenants that we are going to negotiate.
Yeah, you do, like you said, right? A lot of brands people are familiar with, right? Some retail facing names kind of get in the mix there. So you have fitness chains that are backed by private equity, specialty retailers, restaurant groups that have to roll up a bunch of locations, right? That's something that we have been seeing as restaurant chain failures. Hello, Wendy's. Uh,
Yeah.
but
Yep. Yep.
but these companies tap private credit when they want to do an acquisition or to refinance older debt or to even take out a dividend for the existing owners. So behind the scenes, private credit money is funding things like the software layer you interact with at work, the apps and platforms businesses run on, a bunch of the consumer brands that you see out about in the wild. And that's why we give a shit, right?
Yep.
It's not some imaginary thing. It's the plumbing, the infrastructure of money flow that allows great American companies to operate and grow.
That's a good term. It really is like money pipes. Um, so now that we've got you got the basic picture now. I guess the question is like, how are we using this as a barometer for the broader market? And for that, you got to understand that like these private credit funds, they sit very close to the credit cycle. They feel the stress early because they are the ones who see when borrowers start struggling. When they see the interest payments are getting a little too much, when they see they can't sell the loans or refinance deals, or when the investors, the people that gave them the money in the first place, they start asking for their money back.
Yeah, and that's a funny thing that you mention, right? Because we have seen that happening, and that makes their stocks really interesting to watch right now. So if you look at tickers like OWL, ARES, BX, APO, KKR, CG, and some of the BDCs, these really are gauges on your dashboard. One gauge is the credit quality. Are these loans holding up? Another is liquidity. Are investors trying to get out? Are they able to get out? And another is sentiment. Are people really excited to fund this kind of business model? Or are they shying away as they find the risk too high?
Yeah. So, like the logic is if these funds are doing well, they're raising money, they're making loans, these companies pay a good dividend. The stock price, when it's doing that, stock price holds up. That means, what'd you call it? The financial pipes, the money pipes,
Yeah, the financial plumbing,
the
right? The money
financial
pipes.
plumbing.
Either
Yeah.
way, whatever.
Yeah. Those are working. Credit's flowing. Your risk appetite is okay. If on the other hand, you start watching as a whole segment that all these stocks are sliding together, discounts are opening. You said you mentioned BDCs. For those who don't know, those are business development companies. So if you start seeing discounts open up there, or if you see management start talking about redemptions and liquidity management, that's a sign that the underlying infrastructure is stressed. And when that plumbing, that money flow is under stress, it quickly affects the rest of the building, other stocks, other sectors, and the real economy.
It's funny, if would you see management suddenly talking about redemptions and liquidity management because well,
Yeah.
one, that's what they're saying right now. And two, that's usually like Wall Street lingo for those of you that don't know. That's like, so we're kind of fucked right now.
Yeah.
Anyways, anyways, anyways,
Those
let's move on.
cracks are showing up.
Yeah, let's move on to those cracks, right? One of the biggest stories so far has been Blue Owl, ticker OWL. Now they're not the largest player, but it became the poster child because of how the cracks have been showing up. So Blue Owl did a lot of lending to software and software adjacent businesses. On top of that, they packaged those loans into products that were sold heavily to retail investors through advisors, people who thought they were getting a steady yield product, almost like a souped up bond fund. Another good example of this is VCX. Uh,
Yeah.
you know,
That's the
the
one that you were talking about last week on the NQ, right?
Yeah, absolutely. On the NASDAQ Discord. Yeah, this is the one we were talking about.
Okay.
So this one, is a recent IPO of a private credit fund, and it ran about 20x in the days following IPO.
What happened then?
Well, since then, since then, it's given back about 2/3 of those gains,
Okay.
and they're holding a lot of speculative assets that do nothing but burn cash, right? OpenAI, Anthropic, and the realistic value of their assets under management is around 30 per share. And as we are talking, they are sitting well over 150 overnight.
Yeah. And this is what we're kind of worried about is like the three things that kind of hit all at once. You're talking about OpenAI, Anthropic. What happens when the market gets nervous about software and AI? People wonder if these business models are weaker than they looked. Are they actually worth that $30 mark? In a bundle.
It's funny because we just actually got word that OpenAI is going to be shutting down Sora 2.
Hmm. Well, I mean, it's pretty expensive for them.
Very expensive. Anyways, go
Yeah,
on.
yeah. So, we had investors in Blue Owl's one of Blue Owl's funds, because they manage multiple funds. They started asking for their money back, and so what happens is the loans underneath, they're liquid. You can't just dump billions of these in a week and get your full value. So when you have one of these private credit companies capping withdrawals, selling a bunch of loans to raise cash, um, stock's going to take a hit, and that's why we've kind of called this the canary in the coal mine.
No, I just want to take a moment and acknowledge that it's really funny that Blue Owl ended up as the canary, right? The owl
Yeah.
ends up as the canary.
Yep. Yep.
It's poetic even. Okay, so it's not just Owl's stock price either, guys, right? It's what we're talking about spans across the entire private credit complex, right? We see underperformance of alternative asset managing manager stocks versus the broad market. You're seeing BDC discounts to the net asset value widening, meaning that investors aren't really trusting the marks that they're being given. And
That's happening.
yeah, and more discussion of credit issues, watch lists, non-accruals, so on, so forth, right? We're
Yeah.
seeing a lot.
Yeah, we're seeing redemptions and liquidity limits pop up at multiple managers. Uh, I mean, we've got caps on how much investors can draw out each quarter, and they're doing longer payout windows. And that's scariest for an investor. Like that's the scariest thing. Like you have one-time or ongoing gates where you just can't get your full money back when you want it. And that's a liquidity mismatch. And for assets that are long-term and illiquid, but as an investor, you thought you had something closer to daily or quarterly liquidity.
And it's funny because a lot of that's kind of the allure of a lot of these funds, that or giving access to people that generally wouldn't have the wealth to be able to directly invest in these kinds of assets. So you've got these specific funds gating or capping withdrawals, and then markdowns when they're forced to sell. And it's making the stocks of these lenders and managers sell off way harder than the rest of the index they're in. And under
Yeah,
the surface, you've got massively leveraged borrowers, especially in software, right? And AI, who are suddenly facing a much higher cost of debt. And they are not able to find easy refinancing options for the
yeah,
debt.
yeah. And so this really isn't the conversation about these companies. These companies are, our looking glass into what this means, what these cracks would mean for the broader market.
Yeah. So, I mean, I think that we could break it into a few layers, right? So the first layer would be the borrowers. So when private credit funding gets tighter, the first impact is going to be felt by the companies that rely on that funding. Some can refinance, but generally at higher interest rates and stricter rules. Some have to slow their growth and their expansion. They have to stop scaling, cut costs, sell assets, or raise equity in
That's
another way.
that's something you cannot do in that segment, really.
No, not really. I mean, it's incredibly hard to finance it, and the weakest ones end up defaulting on their loans, or they end up having to get restructured, and that hits jobs, it hits capital expenditures and earnings in the economy,
Yep.
right? And then you have the investors. And if funds are marking loans down or taking big losses, that flows through to their shareholders and the wealth management institutions that are holding these funds. So when you start to see dividend cuts or lower fee income, slower fundraising, that feeds into sentiment, right? People get more cautious, not
Yep.
just on
Yes.
these tickers, but across the whole market.
Yeah. I mean, that's signaling to the rest of the market is huge. That's where we've been talking about using private credit as a gauge. When the private credit complex is under pressure, it's telling you that credit spreads are likely to widen, and banks and non-banks may tighten lending, which means that the cost of capital for riskier companies is going up. If you own high valuation tech, anything that depends on cheap financing, really, that's going to matter because the market will eventually reprice these companies when that credit backdrop changes.
Yeah, yeah, absolutely. And I think that we also should think about kind of that feedback loop into indices, right? If enough private credit funded companies end up cutting growth or missing earnings or blow up altogether, that pulls down sector ETFs. It affects sentiment around growth and value, and it can really be the catalyst that turns this healthy correction, quote unquote, that we're in into something that's a bit longer lasting and maybe even a little more violent.
Yeah, I think we need to. I mean, I think it's we're not talking about going out and shorting these companies. We don't know exactly what they're going to do. We are saying that the health of these companies and the health of the loan books underneath are basically your looking glass underneath the economy, underneath the foundation, where the pipes are. And if that loan book is getting stressed, that's going to be bad news for the more fragile parts of the equity market. But let's flip that for a second, because we do have the option that something happens, something turns around. You know what? I don't know how. I don't know how that's going to
you know
happen.
but and it always does, right? We don't know how, but it always does eventually.
Yeah, I mean,
Right. So we recovered from 2008. We could walk through a potential scenario here, right? Because it is plausible, right? I mean, it will eventually be fixed,
yeah,
and who knows when, right? So the first thing you would see would be like the capital flow stabilizing, right? Redemptions of these
the
basically
marks. Yeah,
loans, right? Redemptions would slow down. The funds don't have to sell assets into really weak markets at low
yeah,
prices, and managers can stop talking about gates and liquidity caps, and they can start talking about what they're going to do to fix their fucking business, and that
yeah,
that takes the immediate pressure off.
yeah, yes. And it's just a little thing, if the market gets slightly stronger, because these things are sitting below their liquidity levels. We don't need much. We're seeing a little bit of fear, but I think people want to believe that the stocks are going to go up and to the right. So, what happens if we see that performance stabilize?
Well, if you saw that performance starting to stabilize, right, then you would probably see the alternative asset managers and BDC stocks stop bleeding and begin to kind of base, right, trade in a tight range and begin to start being accumulated, right? You would see the discounts to the net asset value tighten and maybe even flip to small premiums in some cases.
I mean,
We'll wait on that. We'll
yeah,
wait on
yeah,
that, right? That's super speculative. And then you'd see the earnings calls tone from, oh, we're doing everything we can. We're trying to tighten up our operations and exceptional share, right? You would see those earnings calls shift into,
yeah,
hey, look, we're seeing good opportunities to lend at really attractive spreads. I mean, we got to take advantage of this. It goes
and,
from nervous into very
yeah.
confident.
And investors pick up on that, and you know, even you know, if the central banks decide that they are not going to keep hiking, right? If we do get that softer macro lending, we'll see those refinancing windows open, right? I feel like we would. And, borrowers would get to roll their loans onto cleaner terms. And that would give us a default wave that is much smaller than we're worried about right now. You get these walking wounded companies that, they can heal. And in that world, private credit will just normalize. It'll remain a big part of our system. And hopefully they'll kind of learn a lesson on product design and, risk communication. But, the big platforms, especially the diversified ones, actually will come out stronger because the weaker competitors are going to fall away.
Absolutely. And, I kind of want to talk a little bit about that. That the big platforms end up coming out stronger because the weaker ones fall away. So in the wake of 2001, what we saw was probably 90% of these websites, actually, I think it was something like 95% of them, ended up going bankrupt, right? They were basically companies that were built on an idea. They were burning a ton of cash. And Amazon and Google ended up coming out on top, right? And the way that they did that is that they diversified. They were able to secure funding going forward. They had some free cash flow to suggest that they could grow, and they were able to consolidate that entire space and that entire ecosystem that is the internet, right? So that's kind of the catch in a full-on bull market comeback. These same private credit names can go from being the warning lights to being the absolute leaders, because as their stocks are re-rated, they got to shoot back through those liquidity zones where suddenly borrowers, or suddenly investors are now positive on their holdings. So
Yeah.
there's still a lot of space there for us to see some big returns. It would be great for anyone who bought this dip, should it continue.
Yeah. And, we can talk about all these warning signs. We can talk about all this risk. But the fact is that going forward, this market is going to exist. They are addressing a need that will, persist. And, so we've been talking about how we've been, this is just a barometer, but if I see this, if I start seeing the signs that we're going to move out of the basement, I'm probably a buyer a little bit earlier than, what I would normally consider reasonable.
Balls like crazy, man, for
Yeah,
that.
well,
Anyways, no, I get it. I get it. I'm there with you.
yeah.
Maybe not as
You know,
early, but there with you.
I mean, I just need, so let's say we get that piece of legislation, it goes through, we get a House bill that, suddenly benefits these private credit companies, at a level that is disproportionate to something else because,
Like a big bailout. Oh God, don't say that.
I'm not gonna say bailout, but so anyway, so this bailout comes, like yeah, absolutely. Let's zoom out and bring it home. For y'all listening as investors, the practical takeaway is pretty simple. One, watch those private credit tickers. Father, you can put those tickers in the description.
Of course.
Yeah, and watch the BDCs, the alt managers, and be listening for language about redemptions, liquidity, credit migration, because when those gauges are flashing red, that's a clue to dial down your risk,
Other
especially
one
in the
is
most.
headwinds.
Yeah.
You
Yeah.
hear headwinds, you're like, okay, buddy.
Oh, okay.
Okay.
um, you know, you might have to dial down that risk, like I said, especially in the most leveraged, story driven parts of your portfolio. Like if you're playing with something that is all story and no fundamentals, you need to dial that down. But when those gauges start to normalize, it might not mean that, all clear, but it does mean the worst case tail risk is backing off. Market wide private credit's not the whole story. It's not what's going to drive this market on its own. But we do think it's one of the most important segments to be looking at right now. If you treat it as a live stress test instead of just a scary headline, it can actually help you figure out what you want to do to navigate this correction or what this correction is going to be.
Yeah, and we're going to keep coming back to it as it plays out, because the story just simply isn't over. I mean, there's an entire aspect of commercial real estate
Oh my
that
God.
that
Yep.
popped up,
Yep.
and we don't have time to touch on it right now. But the point is to be watching what is happening underneath the market, right? Because it's going to matter a lot more than most people realize, and the reality and the narrative are often very far apart. So what we want to understand is what is the reality, and also what would be the purpose of the narrative.
Yeah. I think you nailed it. I mean, that's where we're at, you know.
I think that's kind of the point that we're at, right? Where
Yep.
I was talking earlier about being at a a big inflection point in one of our last videos, and we ended up being at a really big inflection point, and we've
Yeah.
seen a massive crash since then.
Yeah.
And I think that these things are just worth paying attention to. So
I mean,
thank
and
you for joining me here today. I really do appreciate it. And
right.
I'm sure that everyone watching does as well.
Yeah. Thank you all. Have a good night. Treat
Yep.
yourselves good.
Have a wonderful night, everybody. Thank you so much, and great or good luck
Mhm.
navigating these markets. Cheers.